The information provided in this communication is for informational purposes only, and does not constitute financial advice. It is important to note that past performance is not indicative of future results. Please consult with a qualified financial advisor to determine the suitability of any investment strategy.
The early days of Orcelus, high velocity and pure. Now scale has changed the texture, a future to secure. It's not a flaw, this dilution, it's a map of where we've grown. Embracing this new vision, we've made this fund our own.
Imagine looking at a board, where you literally have billions of dollars in play. The world's most vital shipping lane just closed, oil prices are absolutely spiking, and a global superpower is suddenly cut off from its primary energy lifeline. What do you do? Do you panic?
Well, most people would. You'd think the logical move is to sell everything and hide in cash, right?
Yeah.
But if you're the team running the Orcelus Fund, you do nothing of the sort. You just hold.
Yeah, you hold. Welcome to the deep dive. Today, we're opening up the Fiscal Year 2026 shareholder letter from the Orcelus Fund. And, if you're managing your own portfolio, or honestly, if you're just trying to mentally survive the absolute whiplash of 2026, this letter offers a real masterclass in ruthless pragmatism.
It really does. It's a profound demonstration of stripping the emotion out of investing. They're looking past the immediate chaos to focus on the structural reality of the board.
Exactly. We're going to unpack how a high-conviction fund navigates everything from, artificial intelligence monopolies to supply chain collapses and literal boardroom hostage situations.
And what makes this particular letter so compelling is the timing of it all. Orcelus isn't just observing structural shifts in the world. The fund itself is undergoing this radical internal transformation. They are formally demerging from their founder's personal wealth fund.
Right.
So we are watching them transition in real time from this nimble, high-velocity boutique operation into a very heavy institutional-grade powerhouse.
Let's actually start right there, because that transition creates a bizarre mathematical problem for them. It's something they call the denominator effect. And I was trying to wrap my head around this, and I keep picturing it like making a really intense, perfectly extracted shot of espresso.
Okay, I like where this is going.
Right, so it's incredibly potent, but then you take a whole pitcher of cold water and just pour it in. Your total volume of liquid just went way up, but the immediate strength of your coffee is completely diluted until you can brew more espresso to balance it out.
That is a very, very accurate way to visualize it. In financial terms, the fund is taking on a massive influx of new capital. The denominator, the total size of the fund, is expanding rapidly.
Right, the cold water.
Exactly. But that fresh cash hasn't been deployed yet. It hasn't had time to compound in the market. So their overall percentage returns get temporarily dragged down. They refer to this internally as performance dilution.
Which feels entirely counterintuitive, doesn't it? Wall Street is just obsessed with quarterly percentages, yet here they are, actively choosing what they call optical underperformance. They're willingly sacrificing their flashy high batting average in the short term.
Yeah, they're trading the vanity of a high percentage for the gravity of absolute scale. It's a deliberate pivot.
Oh, interesting.
Because, think about it, if you cap the intake of new money just to keep your return percentages looking attractive, you create an artificial ceiling for yourself. You become a high-performance engine that constantly runs out of fuel.
Makes sense.
Orcelus realized that to participate in larger, more sophisticated acquisitions, they need the dry powder that only immense scale provides. They are choosing to become a steady, unstoppable vessel, even if it means moving a bit slower out of the harbor.
But moving slower in a year defined by so much global volatility seems really risky. Which brings me to their barbell philosophy for protecting all this new capital. They have placed a strict, unyielding cap of 4.5% to 5% on their gold holdings.
Right.
And in a year where global conflict is peaking, gold is the ultimate traditional safe haven. So why are they so adamant about keeping that cap so low right now?
Well, it reveals their fundamental philosophy on wealth generation. They categorize assets into two camps. You have the shield and the sword. Gold is the shield.
Okay.
It preserves the purchasing power of what you already have. But gold is inert. It doesn't innovate, it doesn't hire engineers, and it doesn't solve complex problems.
It just sits there.
Exactly. The swords are productive assets. The letter frames it beautifully. It says, Gold preserves the past, but businesses create what does not yet exist.
I love that. And if they are hunting for businesses that create the future, we have to talk about the sharpest sword in their portfolio. Their cornerstone holding has surged to nearly 22% of their entire fund, and they actually want it to hit 25%. We are talking about Alphabet, Google.
Yeah, and this specific investment is a textbook example of holding conviction through extreme market noise. I mean, go back just 12 months.
Oh, man.
The prevailing consensus was that Google's search monopoly was facing an existential threat from generative AI.
I have to admit, I totally bought into that narrative. I mean, OpenAI had an 87% market share with ChatGPT at one point. It really felt like the race was over before Google even tied their shoes.
A lot of people felt that way.
Right. Yet the letter notes that in late 2025, Google launched Gemini 3 and completely flipped the script. Gemini's market share nearly quadrupled to over 21%, while ChatGPT plummeted down to roughly 64%. How does a company claw back that much momentum that quickly?
By weaponizing their scale to discommode the competition. Google realized they didn't just need to build a better reasoning engine,
Yeah.
They needed to remove the friction of access.
What do you mean by friction of access?
Well, they embedded Gemini directly into the default habits of 3 billion users. When you integrate AI into Android, which holds 71% of the global mobile operating system market, and then you bake it into Workspace and secure the partnership to power Apple Siri, you completely change the paradigm.
Oh, wow. So you don't even have to go looking for it anymore.
Exactly. Generative AI stopped being a standalone website you had to actively visit, and it became an invisible utility powering the devices people already use every single minute of the day.
The distribution advantage is just wild. But the letter goes deeper than just distribution. They break down Google's protective moat into 5 specific pillars. And the hardware piece really caught my eye. They mention Google is using its own Ironwood TPU v7 processors.
Yes.
Why does owning the physical chip matter so much for a software product?
Because it creates a structural margin defense that startups just cannot replicate.
Yeah.
Think about the unit economics of AI. Most AI companies have to rent compute power from cloud providers.
Right, like AWS or something.
Yeah, effectively paying a massive margin tax to companies like NVIDIA.
Yeah.
But Google designs its own silicon specifically optimized for its own models.
Ah.
The fund estimates this allows Google to run Gemini at roughly 20% of the cost of their competitors.
20%?
That's insane.
It is. When your underlying compute cost is a fraction of the industry average, you can offer way more compute-intensive features to users without bleeding cash.
And then you add the data advantage. We always hear that AI models are only as good as their training data, right? Startups have essentially scraped the entire text of the internet. The text well is running dry, but Google owns YouTube.
And that is the crucial transition from large language models to large multimodal models.
Because text is finite.
Exactly. Text is finite. But YouTube is the world's largest continuously updating library of video, audio, and spatial reasoning data. Teaching an AI to understand the physics of the real world,
Yeah.
how objects interact, how human expressions change, that requires video.
Right.
That is a proprietary data set that no competitor can access or replicate.
So when you stack the custom chips, the YouTube data, a $155 billion cloud backlog, and the network effects of controlling search, you start to see why the fund is so bullish. It's a $4 trillion machine generating $120 billion in annual net income.
And the ultimate validation came right at the end of 2025.
Mm-hmm.
Right before Warren Buffett retired, he took a $4.3 billion stake in Alphabet.
Oh.
It was a profoundly symbolic move. Buffett famously avoided the tech sector for decades. He called his failure to invest in Google earlier his biggest error of omission.
Interesting.
He recognized the fundamental strength of their model years ago when his insurance company, Geico, was paying Google $10 a click for ads that cost Google absolutely nothing to produce. It is the ultimate digital toll bridge.
So Google represents the apex of unassailable scale. You literally cannot compete with their resources. But Orcelus isn't exclusively playing in the trillion-dollar sandbox, which is cool. Let's look at the other end of the spectrum, a company making up just 4% of their portfolio, which gives us an incredibly messy, high-stakes look at global supply chains. Raycon.
Yeah, Raycon is a relatively small New Zealand manufacturer, but their technological footprint is crucial. They design and manufacture high-performance quartz crystals and oscillators.
The fund calls them the heartbeat of modern electronics. These are the components providing the sub-microsecond timing needed for 5G network synchronization, the Mars rover, and even the recent lunar landing on the moon's south pole.
Yeah, and the initial entry into Raycon was opportunistic. Back in 2021, a literal fire destroyed a rival manufacturing facility in Japan.
Oh, wow.
Right, so it created an immediate massive vacuum in the global supply chain.
Oh, wow.
Orcelus stepped in. However, they had to navigate an intense ethical vetting process first.
Because of the military applications, right?
Exactly. Historically, Raycon's highly precise components had been utilized in smart bombs and missile guidance systems. The fund's mandate strictly prohibits investment in military weaponry.
Okay.
So they had to verify that Raycon's current revenue streams were definitively siloed into high-spec civilian, telecommunications, and scientific applications.
Okay, so they pass the vetting, they literally make parts for lunar landers, they seem primed for success, but the real drama here isn't happening in space. It is a brutal lesson in boardroom physics. Raycon became the target of an acquisition by a U.S. semiconductor giant called Skyworks. They offered $1.70 a share, valuing Raycon near $391 million, but the deal completely imploded.
It imploded because of the long shadow of geopolitics.
Yeah.
Years prior, in 2011, Raycon had entered into a joint venture in Chengdu, China. For a U.S.-based acquirer like Skyworks, operating under today's intensely strict U.S. technology export controls, any exposure to Chinese manufacturing or state-linked telecom customers is just a non-starter.
The compliance risk was just insurmountable.
Completely.
So to save the company's future and remain a viable acquisition target for Western capital, Raycon had to undergo an amputation. They actively dropped a major Chinese telecom customer that accounted for 5% of their total global revenue just to scrub their compliance profile clean.
And that painful pivot technically worked. They attracted a new buyer, Borns. But the new offer is only $1.55 per share, which is significantly lower than the Skyworks bid.
And the letter explicitly states that Orcelus values Raycon at $1.60 per share. Taking the $1.55 offer means leaving a 5-cent per share difference on the table, which translates to roughly $11.4 million in total market cap just vanishing. So if this is a high-conviction fund that believes in holding the line, why on earth are they folding and taking a haircut?
Because holding the line only works if the market structure actually allows it. Borns executed a masterful, super aggressive takeover strategy. Before the offer even went public, they secured binding lockup agreements with Raycon's top 3 shareholders. The moment the bid was announced, Borns already controlled over 41% of the voting rights. They effectively neutralized any possibility of a competitive bidding war.
Wow. And this brings us to the intricacies of the New Zealand Takeover Code. If a bidder reaches 90% ownership, they trigger a compulsory acquisition, meaning they can legally force the remaining minority shareholders to sell and take the company entirely private. But Borns doesn't have 90%. They just have majority control. Why is Orcelus panicking?
Well, they aren't panicking. They are assessing liquidity risk. If Borns secures, say, 60% of the shares, they don't have to walk away. They can waive their 90% condition and settle for a majority stake. Raycon technically remains a publicly listed company, but Borns now dictates the board composition, the capital allocation strategy, and the dividend policy.
And the letter details the mechanism that makes this truly dangerous. It's called the 5% creep rule. When I was reading this, it honestly felt like being trapped in a room with a very slow-moving python.
That's a great analogy.
Right. It doesn't strike and consume you all at once. The takeover code allows a majority shareholder, once they cross the 50% threshold, to slowly acquire an additional 5% of the total shares every 12 months without ever having to launch a formal premium takeover bid.
It is a mechanism of slow suffocation.
Yeah.
In year 1, they hold 60%. In year 2, 65%. As they slowly absorb the remaining shares, the public float. The number of shares actually available to trade it just evaporates.
Institutional investors flee because there isn't enough daily volume to enter or exit positions safely. The stock essentially becomes a ghost town.
Exactly. They reduce market liquidity year by year until they inevitably hit that 90% mark on their own timeline. And when they finally force you out, the price could be significantly worse. The fund realized that if they didn't take the $1.55 offer right now, they would become a sitting duck in an illiquid trap.
It is a sobering reality check. I mean,
Wow.
you can have world-class technological superiority, you can literally build components sitting on the surface of the moon right now, and none of it protects you from the cold, hard math of a corporate buyout and geopolitical red tape.
No, it doesn't.
Which provides a perfect bridge to another wild ride in their portfolio. Because sometimes the biggest threat to a company isn't an external buyout, sometimes the vulnerability is internal. Let's look at the A2 Milk Company.
Yeah, the A2 milk narrative is a really fascinating exploration of how perceived financial safety can actually become a structural weakness. They acquired their position in 2020. Dairy is the foundational economic engine of New Zealand, right? It accounts for over 25% of the country's export earnings.
And on paper, A2 Milk was the ultimate pristine investment. They operated an asset-light marketing model, meaning they didn't have the heavy overhead of owning farms or factories. And they had a fortress balance sheet with zero debt. I mean, we are constantly taught that being completely debt-free is the pinnacle of financial stability.
Well, it is stable right up until the ground underneath you completely shifts.
Yeah.
The company ran into a catastrophic combination of macroeconomic and demographic shocks in their primary growth market, China.
Right.
First, the Daigou supply chain, which is the informal network of individuals buying premium milk powder in New Zealand and shipping it directly into China, that froze entirely due to sustained border friction and changing customs regulations.
But the truly terrifying shock was the demographic data. Official Chinese census figures revealed birth rates plunging to their lowest level since the 1960s. Add in rising youth unemployment and the Tang Ping or lying flat social movement where young people are actively delaying marriage and child-rearing, and you have a crisis.
Absolutely. When your flagship product is premium infant formula, a rapidly declining birth rate means your total addressable market is structurally shrinking. You cannot simply outmarket a demographic collapse. You are fighting over a smaller pie in a country that is simultaneously prioritizing domestic self-sufficiency in its food supply.
So the informal supply chain is dead, the market size is shrinking, and regulatory hurdles are rising. Under those conditions, R2 Milk should have failed.
They really should have.
Instead, they executed a radical pivot. They abandoned the asset-light model entirely. They deployed their massive cash reserves to purchase the Yashili and Pocono dairy manufacturing plants. They transformed into a vertically integrated producer.
Which was brilliant. By taking ownership of the physical factories, they fundamentally changed their risk profile. They now controlled their own production timelines, their own quality assurance, and crucially, their own China-labeled product registrations.
Right, they didn't have to rely on anyone else.
Exactly. Rather than relying on third-party manufacturers, they took control of their own destiny. They aggressively pursued market share within that shrinking demographic, successfully becoming the fourth largest player in China's domestic infant formula market, and generating enough free cash flow to issue a $300 million special dividend.
The survival pivot is impressive, but the lesson the fund took away from this is what really blew my mind. They looked at A2 Milk's near-death experience and concluded that the company's pristine, zero-debt balance sheet was actually a liability.
Yeah.
It was a wild thought. We are conditioned to believe debt is an inherent negative. Have you ever been so comfortable in your own life or career that you stopped innovating? Why would the fund prefer their companies to owe money?
Because absolute comfort breeds corporate complacency. The fund's analysis points to historical cautionary tales, like Kodak and BlackBerry.
All right, classic examples.
Those companies didn't collapse because they lacked capital or brilliant engineers. They collapsed because their dominant market positions and massive cash piles eroded their sense of urgency. They lacked the on-guard mindset required to recognize disruptive threats.
They just got too comfortable.
Yes. The fund realized that a board of directors sitting on a mountain of cash with zero obligations can very easily fall asleep at the wheel. Consequently, Orcelus has pivoted its philosophy to embrace manageable debt.
Manageable debt.
Right. They want the management teams of their portfolio companies to feel the friction of the market. Servicing debt requires constant cash flow generation, which requires constant innovation. They are actively trading a culture of financial ease for a culture of relentless performance.
Speaking of being forced to perform under pressure, the supply chain tremors that nearly derailed Raycon and A2 Milk feel incredibly small compared to the macroeconomic environment the fund is outlining for Q1 of 2026.
Yeah, they really do. And this requires a critical framing mechanism before we get into it.
Yes. Before we get into this next part, I need to make something really clear. The macroeconomic events detailed in the final section of the Orcelus Letter involve highly charged, ongoing global conflicts. Our role here in this deep dive is to examine the fund's structural and economic analysis of these events. We are strictly focusing on how they project the flow of capital and commodities will be impacted. We are absolutely not taking any political sides or endorsing any military actions. We are just reporting what's in the source material.
Right. We are looking at the board through the eyes of the market, not taking a stance on the geopolitical players. And the market right now is experiencing what the fund calls peak uncertainty.
And that's putting it mildly. Domestically in the U.S., you have a Supreme Court ruling on tariffs causing a total freeze in corporate operational planning. You've got a transition in Federal Reserve leadership keeping rate expectations highly volatile. And the introduction of the OBBBA tax bill inflating the entry costs for new investments.
But the domestic friction is heavily overshadowed by two massive concurrent military operations initiated by the United States that have fundamentally rewired global energy markets.
Yeah.
Operation Absolute Resolve, which successfully targeted and captured Venezuela's Nicolas Maduro, and Operation Epic Fury, a joint U.S.-Israeli strike reportedly resulting in the death of Iran's supreme leader.
The immediate physical consequence of these operations is just staggering. The Strait of Hormuz, the choke point between the Persian Gulf and the Gulf of Oman, is effectively closed to commercial shipping.
Completely shut down.
Maritime insurance for tankers has been entirely revoked. There are currently 150 massive vessels anchored outside the strait. We are talking about 17 to 20 million barrels of oil per day completely trapped. That is roughly 20% of global daily consumption removed from the board in an instant. The fund is projecting Brent crude could easily breach $91 a barrel, with significant upside risk from there.
And you cannot engineer your way out of that geographical bottleneck.
Yeah.
While the United States is the world's top individual oil producer, global crude prices are set by global supply.
Right.
Saudi Arabia and the UAE possess overland pipelines designed to bypass the Strait of Hormuz, sure, but those pipelines can only accommodate a fraction of the trapped volume. The supply shock is absolute.
But the fund's analysis takes this from a severe energy crisis to a potential existential threat. They argued these two military operations are not isolated incidents targeting regional bad actors. They view this as a coordinated grand strategy by the U.S. to systematically dismantle China's pawn network.
Exactly. Venezuela and Iran function as critical energy hubs for Beijing. By neutralizing them simultaneously, China is suddenly facing a 15% reduction in its total crude imports.
This is where the historical pattern recognition of the fund becomes chilling. They draw a direct structural parallel to 1941. In the lead-up to World War II, the United States imposed a devastating oil embargo on Imperial Japan, intending to force a change in their military expansion in Asia.
Right, the U.S. viewed it as a diplomatic tool of economic leverage. Japan, however, calculated they only had a few months of oil reserves remaining.
Yeah.
They viewed the embargo as a death sentence for their nation.
The cornered animal theory. Instead of capitulating, the embargo forced Japan to launch a preemptive strike on Pearl Harbor to clear the Pacific board so they could secure the oil fields of Southeast Asia. The fund is warning that intentionally strangling a modern superpower's energy supply is not a negotiating tactic. It removes all incentives for diplomatic peace. If China calculates they are facing an energy collapse, it could trigger an immediate military response to secure trade routes, a scenario that rapidly spirals toward World War III.
It's terrifying.
So I have to ask the million-dollar question. If the Orcelus Fund sees this level of apocalyptic risk on the horizon, why aren't they dumping their entire portfolio and hiding in a bunker?
Because panic destroys compounding. Their official strategic posture remains a strategic hold.
Wow.
Despite the massive geopolitical risk and the inflation threat from oil, they observe that asset prices in the U.S. market remain stubbornly, almost irrationally high. They simply refuse to use leverage to chase overvalued assets in a fragile environment.
So they're keeping their powder dry. They are waiting for the reality of the oil shock to fracture the market, hunting for what they call distressed quality, exceptional companies that are fundamentally sound but are forced into fire sales because their debt matures at the worst possible time.
It requires immense discipline to sit still when the board is shaking. They're relying on the structural advantages we discussed earlier, Google's proprietary silicon, A2 Milk's vertical integration, to allow their core holdings to survive the storm while retaining the cash reserves to capitalize when the valuation bubble inevitably pops.
It is an absolutely incredible journey to trace. This is a fund that started with a literal $100 initial investment from its founder, and today we are watching them weigh the impact of lunar lander components, manage trillion-dollar AI monopolies, dissect the brutal math of New Zealand takeover law, and attempt to map out the economic blast radius of global warfare.
It really perfectly encapsulates a quote from the founder included in the letter. He says, "Don't just study the map, walk the terrain. The simulation is what's on paper. Reality is the dirt under your fingernails."
Reality is the dirt under your fingernails
Yeah.
is a powerful call to get skin in the game. If you are listening to this, whether you are trying to build a business, manage your career, or navigate your own investments, studying the theory is never enough. You have to engage with the friction of the real world.
Absolutely.
But walking through this letter also leaves us with a truly fascinating tension to ponder. We started this conversation by examining how the Orcelus Fund is actively choosing to shed its fast-moving agility. They are embracing the heavy, sluggish nature of massive institutional scale, accepting that optical underperformance is the necessary price for permanence.
Right.
But when you survey the terrain, they just mapped out a world defined by sudden straight closures, AI paradigms shifting in a matter of months, and geopolitical compliance traps that can destroy a buyout overnight. Is scale truly the ultimate safe harbor? Or is it possible that in a world moving this violently fast, the nimble agility they were willingly walking away from was actually their greatest protection all along?
That is the essential question for anyone trying to build an enterprise designed to outlast the current chaos.
Keep questioning the narrative. Thanks for joining us on the Deep Dive.